All right, to everyone else, we are going to go ahead and get started with the next space here. So I'm sure you all aware today was FOMC day. We had a lot that was going on in that part of the world where markets responded wonderfully, right? We found out that we're likely not to have that next 75-point rate hike. We'll probably stay under that. Markets really like that. Jerome Powell talked about the place that our economy was in. So we went ahead and we got some great speakers that are up here now with us. And we're going to dive a little bit into this and explore it for about an hour. And then I have another space at 7 p.m. EST. So definitely make sure that you're sticking around. I will put out a tweet about this in a minute. But while we are getting there, let's go ahead and get rolling with it. Wolfie, I don't know if we've chatted in the last few hours. So I'd love to kind of come to you first, get some initial takes here, and then I'll bring it over to Tarek and some others. Take care, Blake.
Yeah, for sure. We mentioned this briefly yesterday on a space. It was the analytics company. I don't remember the name. I'm sorry. The company that like lets you bet on scenarios. We touched on it very briefly, but essentially, going into today, you had a like a real like dreary place for investors where you have inflation being an issue, you have Russia, Ukraine being an issue, you have lockdowns in China being an issue, and then you had a 100% chance for a 50 basis point hike today. And then yesterday when we were having that conversation, and I've mentioned it on Twitter and a couple other places as well, but there were um, expectations for a 75 basis point hike in on the next meeting. And so I think I'm trying to find the exact number, but the Fed funds futures rate had it, as a likely possibility, more than just likely possibility. Like it was pretty much like going to happen. So we were talking about it yesterday from a gamification standpoint, just like, at some point you get to a point where things are so bad, the fear is so bad that anything that's not as bad gets perceived as good. And I think that's kind of what you had. Is just the Fed made an active decision to, with the market being where it was, and with the economy being where it is, and with inflation being where it is, rates being where they are, et cetera. The Fed made an active decision to just not be aggressive. So that's one. Two, the real fear for the 75 basis points and for the Fed being aggressive now is if you are thinking of it from a perspective of the Fed has two mandates, right? And they tell you that they have two mandates. They have they want to have maximum employment or as little unemployment as possible. I think they call it a full labor participation, and then they want to keep inflation down. So they're telling you that they're at a point where you basically have peak employment, and then they're telling you that inflation, they don't have to tell you, but like inflation's running rampant. So the fear was and is that they will be aggressive at the worst time, which is when inflation has peaked or come close to peaking, and then that their tools and things that they would use to try to ease that inflation would happen when naturally markets themselves start to relieve some of the pressure, right? And so that's kind of like the impetus for the rally. As soon as you heard that they were not, quote, actively considering the 75 basis point hike in June, you saw an aggressive rally. Because if you just think of it from a perspective of someone who is negative, right? So just think of someone who's like shorting or selling or whatever. As soon as they tell you that that's something that's not going to happen, that individual has to completely flip, right? So they have to now price in the fact that they were offsides and then they have to go relieve that tension. And then when you price in the fact that you've had, the bull bear sentiment being at the lowest point since 1992, like it gets to a point where it's like, who's left to sell at that point? And that the actually snapback is to the upside. And so that's kind of like what we saw. That's exactly what happened. They really walked it down. But the one thing that I will say is that if you go back and read the press conference, or if you listen to it again, you get to a point where the way that he said things was, sorry, my dog's going a little crazy. The way that he said things was, it wasn't as, clear cut as possible. So they said they were not actively considering something. He also said they were going to be data dependent. He also said that they have blunt tools, so they have to be cautious with how they use those blunt tools. And then they also said that they can't allow a wage price spiral to happen, and can't allow inflation expectations to become unanchored. We can't allow it to happen, and that they won't hesitate to go above neutral if necessary, but that they do understand that their tools are very blunt and limited, so that they kind of have to ease into it. So I would like to see. I know I've rambled here for 5 minutes, but I'd like to see some sort of follow through, and I'd like to see if what I'd like to see from a market structure perspective, from investors' perspective, stuff like that, is that this is something that they're building off of, and that this is something that could sustain. The worst thing that could happen is that you get this kind of rally, and then now people have 24 hours to consider it, and then by tomorrow they go, "Hey, wait a minute." They're hiking 50 basis points today, and they said they're going to hike 50 basis points in June. That's still a percent here in a short period of time. So how dovish are they, right? So that would be the absolute worst thing, or some crazy exogenous thing from Russia or from China that really just wipes out the steam. But the 75 basis point priced in, and then them not actually doing that is and was a tailwind for risk assets today. And you saw that with stocks, you saw it with bonds, you saw it with yields, etc. Sorry, I know I've rambled here for about 6-7 minutes, but I just wanted to cover it all on my end.
No, that was a great start there. Appreciate you, first off, just kind of leading us down the path. And I think you hit on a lot of points really well, really, really well. And surely sentiment has changed for the next several months with the way we're going about it. All right, I got stock market news up. I'm going to bring up Alan Sahil. I see you're in the crowd. It'd be great to have you up here. I know you are a little busy and unable to speak right now, but if you are able to come up, that would be fantastic. We'd love to even have you just on the panel. Let's see what else is going on here. Stock market news. I dropped you co-host. How you doing? All right, cool. Looks like we're rolling here. All right, let's bounce off Wolfie. Let's go over to you, Tarek.
Absolutely. I'll let William Xavier take it first, and I'll close up.
Yeah, absolutely. Today's news was not surprising at all. The markets were suggesting 95% chance that this was going to have a 50 basis point hike. Incidentally, markets were a little split about the announcements of the 50 basis points in the future, because if you go to the CME futures, they were saying that they were expecting with over 50% chance that there would be a 75 basis point hike in the June meeting. But our markets were saying a Kalshi that it was about a 75% chance that it was going to be a 50 basis point hike. It does seem that it's going to be closer to the latter, that it's going to be 50 basis points. But I don't think that the thesis that, markets could wake up tomorrow and say, oh, wow, 50-50, that's a full point, and then the markets tank. Could the markets tank tomorrow? Yeah, they can always tank. Volatility is a real thing. It happens every day. However, markets have been pricing in at least 100 basis point hike over 2 meetings for several months. Markets are fairly efficient. They've already priced this in. So I don't think that one can predictably say, all right, the market's going to wake up and realize that this is not that dovish. All of these things have been factored in. I think the number one thing that the Fed did today was just project stability, which is saying we are not going to throw a wild card into the wrench. We're not going to go crazy. We have been signaling for months, or at least several weeks, that this is what we're going to do. We are following through. And I think the reason the market went up today is less of because of its dovishness or anything else. It's more of just a expression of stability and predictability. And I think that's what we saw.
Yeah, I think today what the Fed really tried to do, and this is something we discussed in our recent space, is try and regain its credibility. Over the last 6 months, because of the way that inflation has moved, they've lost a lot of that and acted very timidly, even when the time came for action, especially back in March, when they only did a 25 basis point hike. And now they're following through on a higher one and leaving the door open on an even higher one, a 75 basis point hike. You notice throughout his discussion, Powell emphasized that he is fully committed to ending fully committing to ending inflation and bring back price stability. And that's why you have this really good sort of in between where he's both signaling that he's willing to take severe and aggressive action if necessary. And it's good we're discussing a 50 basis point hike as mild. That is accurate, even though it was considered to be crazy just a few months ago. In the face of current rates, it makes a lot of sense. Whereas a 75 basis point one would be aggressive. This is exactly what the markets want. It's why they reacted positively. You're able to try to toe that line. That's what a soft landing is. We're going to stop inflation. However, we are not going to kill growth unless we need to. And we're going to be very clear and set expectations about the future rather than just engage in prolonged uncertainty. So I think it was actually a really positive experience. And clearly, market participants have reflected that.
What do you expect to see the next couple of days, guys?
I would expect to see, as we see after every meeting, some level of volatility. Notably on Friday, we get the jobs report next, and then at the start of next week, mid-next week, we get the inflation report, and markets will move on that. But whenever you have a Fed meeting, there's just some amount of volatility. But I don't think actually, and this is a position I have of, I don't think one can predict, say, I think the market is going to move in X direction tomorrow because of something that already happened, because that information is going to be incorporated very fast. We can, the extent to which we can make predictions about markets, we can make them say, yes, in the long run, markets tend to go up. That is a general feature of, well-diversified portfolios. But when we say, okay, the Fed made a 50 basis point hike, how are people going to react tomorrow? Well, any feelings about it are going to be incorporated at 2:01 p.m. when the decision is made, and then from 2:30 to 3 when Jerome Powell is making his comments, and then, the market has to shake itself out a little bit as people actually dig into what he actually said and process it. But I don't think I think the information from the hike today has been fully incorporated into the markets. And I don't think we should, while the chance of it going up and down is larger than normal because we're in the period we're in, I don't think it's in unidirectional.
I have a different take about this situation. I think that, everyone kind of saw that when Powell said there's no chance of a 75 basis point hike, parabolic intraday. I do think it was a dovish meeting. There was a 50% chance if you look at, the work function or what expectations were for rate hikes, whether you believe it or not, and I didn't believe that they would hike by 75 basis points, there was a decent probability of a 75 basis point hike for May and June, especially June. And then the 3-month outlook for half the QT. By the way, the Fed has still been doing QE through April. They've been buying bonds, believe it or not. And, I think the fact that they said that they're going to cap treasuries at 30 billion and MBS at 17.5 billion was much more dovish than the market had expected. And not only that, there was some risk in the market. If you were talking to the guys on the sell side that, consensus is made up of, that there would be potentially not just passive roll-off of treasuries and MBS from the balance sheet, but also potentially forced sales of MBS that might be sterilized with treasury purchases. If that risk was taken off the table, I think, part of it was because mortgage rates are already 5.6%. There's no buyer for long-dated MBS anymore. The buyer, used to be Japanese banks, but with the Japanese yen falling to 20, falling the fastest since 2002, the currency vol associated with that and the FX hedge cost, outweighs the incremental yield benefit. So, there are fewer buyers of this type of paper, and I think the Fed defaulted to being more careful. So, again, it's all relative, and I know 50 basis points sounds high because it's the highest rate hike we've had since 2000. But we've been in a dovish environment for 14 years, in a bond bull market for almost 40 years. So, relative to expectations, it was fairly dovish. And I think, going forward, we really have to look at inflation data and growth and GDP data to see if the Fed, has waited too long to get to the neutral rate.
Perfect. Thank you, Jay. I see a couple of hands up. I want to bring some people in. Alan, I saw your hand, and then over to Wolfie.
Yeah, you said something very interesting. I think the Fed doesn't know what they're doing. I don't think they have a clue. I don't think they know how to fight inflation. And the speaker just before said something very interesting. They are still buying bonds, which is stupid. If they have this plan where they're going to roll off, why are they continuing to buy bonds? That's number one. Number two, was this a dovish statement because Europe isn't really in bad shape? That's number two. And number three, the 1 year Treasury bill. I bought some 1 year Treasury bills today at 2%. So that means that Fed funds, if there are 100 basis, if they're going to go up 50 basis points and another 50 basis, 125 basis points, that's still the 1 year Treasury bill indicates that there's more behind that. Now, I lived through 1981, I lived through 1990, 1974 recession, and I know what it takes to fight inflation. And I don't think this Fed has the political strength to fight inflation properly. So I think this was a nice rally. I think people will take advantage of this. And then they'll wake up and say, hey, we still have inflation. What are we going to do with it? And the Fed, and as the last speaker said, what happens when they start selling mortgage bonds? If they do sell mortgage bonds, we don't know. We don't know how they're going to proceed. And I think 100 basis points in the next two meetings is going to be like peeing in the ocean. I'll pass it on to whoever wants to speak. And thanks for letting me speak.
Yeah, Alan, appreciate you coming up. All right, that was quite fascinating. I'd love to turn it over to you, Wolfie, for whatever you wanted to say, and if you want to respond to that as well, or add to it.
There was a statement that was in the initial that was, quote, the committee is highly attentive to inflation risks, end quote. And so when Sahil asks, how do we think things are going to go the next couple of days? I'm not sure how we define the next couple of days, but I do expect at some point here between now and the next meeting, the next print, to hear a bunch of these Fed members, voting and non-voting, to come out and really jawbone and talk about how, actually, the 75 basis point isn't off the table. It just wasn't on the table at the time. Or we have to be cautious, but we also have to respond to keep inflation down. Because if you just take a look at some of the rhetoric that Powell himself was using, he started by addressing the American public, or I guess the world public, but specifically the American people, and saying, hey, we realize that inflationary pressures are affecting you. And he actually addressed the people, on the front end, independent of everything else that was said about the rate hike, et cetera. And so this was interesting to me, because they're telling you that the way that they measure inflation, which is different than the way most people feel inflation, that they are cognizant of it, right? So he's telling them we're cognizant of it. The second part is, and this is not the first time he's done it, and he did it during COVID, and he's been, pretty steadfast about it. He goes out of his way to really mention minorities, and goes out of his way to mention people at the lower end of the socioeconomic, class, right? So he makes it a very important point to mention those people and say, hey, there are factors that are not in our toolbox, that are not in our mechanisms of measuring this stuff, that impact you guys more. And we understand that we have to take actions to really kind of keep those people in mind, and to make sure that those people are not affected. So I find that important, and I find that interesting, because, again, it depends on what you mean by the next couple of days. If we're talking about 1, 2, 3 days, I don't know. But I don't think that inflation is, just going to come. We could lap tougher inflation comps, and inflation come in, but it could not come in enough really like materially impact, people, those same people that he's coming out and speaking to, right? And so in instances like that, lapping inflation comps that make it appear as though inflation is going to come down. And I think I remember last year there was like it might have actually been Ramp who brought it to my attention last year, but there was a post from the White House that was talking about how like your barbecue this year is 4 cents cheaper. And it was like an actual like White House letterhead tweet, and it was just like hilarious and so out of touch, right? And so I bring that up to like mention the fact that we could be lapping, inflation peaks, right? And inflation come in, but like if you're saving a quarter on your barbecue, like the average person doesn't feel that, right? And then the second aspect of it is, he made a point to mention that wage costs are actually something that they're monitoring, and that gas prices and food costs are eating into the lower end consumer, right? And so these things being mentioned in a meeting where he says that they're not, quote, actively considering it, doesn't mean that it's off the table. Because I don't think that like come 1 week from now, 2 weeks from now, a month from now, gas prices are going to materially come in, or that like, food prices are going to materially come in. So I don't think that those things are just going to like magically disappear. And so I actually think, and like I agree with Jay on the MBS side of things, but I actually think that at some point here in the next couple of weeks, if we've learned anything from how the trade has been this year, right? So it's buy the print or buy the print, sell the minutes. So buy the meeting, sell the minutes, right? So if you just and I can share it here in a minute, but if you go back and take a look at the chart of the last 2 times that they've had a Fed meeting, they buy the meeting, it rallies for a little bit, and then the minutes they start to fade there, and then after that you start to hear some serious jawboning from the Fed. And I don't know if we've seen anything that's going to like shake that or change it.
Got it. All right, I see a couple of hands. Special.
Thanks, Noah. I think that was great. I do definitely agree that job owning is, we were in a blackout period, as you guys recall, in the week before this Fed meeting, you had Bullard and Meltzer and all these, and Mester and all these Fed governors. We had sometimes 7 Fed governors speak per week, and everything was muted, right? So we went into this Fed meeting, everyone was fully hedged. We got something incrementally bullish. That doesn't mean that all of a sudden, we're in the clear. Going into the mid-March meeting, we saw, a bear market rally, as, hedges, you saw today, vol completely collapsed, right? So as vol collapses and volatility collapses in your put options, your delta also falls, right? And then dealers have to hedge that by buying stock. And that was kind of what we saw last time. This time, I think we just saw a lot of buy volume. Like if you just saw volume, the straight volume on the NASDAQ and S&P 500 futures, it was incredibly high. So it looked like there are people waiting on the sidelines to buy based on what happened, during the last rally. To answer Sahil's question, what do we think about what's going to happen over the next few days? Again, I don't know how to define few, but we have a CPI print coming up, which I think will be very important. I do think there's a over 50% chance that this CPI print, which by the way doesn't really represent inflation. CPI is the change in the price of a basket of goods that's arbitrarily picked, just like PCE, which is what the Fed uses. And it leaves out real estate, right? Because it uses OER, which is an estimate. And real estate rent prices and property prices are both up almost 20% year over year. And so the inflation that the Fed is talking about, the single mom in Chicago that's seeing her rent go from $1,500 to $1,750, is seeing her gas budget go from $80 to $160, is seeing her grocery bill up 17%, and is now going to see, with natural gas prices almost at $9 in shoulder season, her heating and electricity bill probably double by the winter or triple, followed by rolling blackouts and brownouts in California and Texas because of instability of ERCOT. I don't think the consumer is set up well for the next few months. And keep in mind, like energy prices are also, subdued, right? You saw oil Brent go to almost 140, came back down, primarily because of Chinese lockdowns, right? You have 185 million people locked down in China. That number is growing. You have even Beijing was locked down. I think by the end of May, June, those lockdowns will probably stop. And so while core PCE and core CPI might come down just because of the year-over-year effect, and because inflation was already 5-6% by May and June of last year, you might see inflation continue to rise in food and energy. And I think the Fed is sensitive to that. And Gunlock today, about 30 minutes ago, said he thinks inflation is peaking, but that's, I think, core inflation, and it doesn't account for the geopolitical risks and the supply chain risks that we're likely to see come back because of the 8 weeks of lockdowns. You can also, if you subscribe to Freight Waves, you can actually see the number of container ships coming to the U.S. is down like 20%. So you're going to see those supply chain issues come back. There's just so much noise out there. I think one thing that individuals don't talk about for the next couple weeks is, earnings outlooks have been pretty dismal when it comes to consumer-related sectors, whether it's subprime lending, the Carvanas, Affirms of the world, or companies like Gap, which completely whiffed, or companies that are just seeing commodity issues like Clorox because of resin and transportation prices. It's essentially a commodity company, but resins are a byproduct of petroleum. It got completely smoked after earnings. So, we might be at peak margins, and this euphoria because of the Fed and people trying to replicate what happened in March, we might see some short-term strength in the market. Again, no one has a crystal ball. I agree with William, but that would probably be an opportunity to sell the rip, right? For the last 14 years, we've been in a buy the dip market. And I think starting in November of 2021, I think we talked about this, I think, many times, Wolf and Wolfie, we've been in a sell the rip market. And, you could potentially generate some reasonable returns on both sides. And again, going into this print, I think it was smart to be more neutral, but going forward, I think it will be a very challenging and choppy market, and it will be range bound. The one thing that can keep this going is if inflation really does come down and stays down. But I'm not really confident. I think if the overall level stays above 5% for the year, the Fed will have no choice but to continue on the tightening path.
Perfect. Appreciate the thoughts there, Jay. All right, I'm going to call hands as I saw them go up. I saw you first, Alan. Alan? All right. Hearing none from Alan, we're going to go over to Bill.
Sorry, can I just jump in here? Whoever just talked was 100%. Wolfie was 100% right about the continuation of the diversity pitch that Powell made, which he's been making since he's been chairman, and I agree with him 100%. And I agree with the notion that the single mother in Chicago is going to get killed. And if you remember the last time Powell spoke, he was rather dovish during his Zoom meeting. But when you read the minutes, it was just actually much more bearish. So I wonder how the market's going to react in here. And also, if Europe does raise their rates, as they've indicated they're going to do in June and July, or July and August, how is that going to affect us? Right now, with the euro at 105-ish, that's pretty damning and tells you that they expect our interest rates to go up. I think Europe is still going to continue to be a buyer of our securities, whether it's equity or debt.
Got it. Appreciate the insight there, Alan. Real quick, before I drop over to Bill, we have 400 plus people in the audience. Just want to thank you all for tuning in with us today. It's been quite an eventful day on Spaces. I've been live since about 9:15 a.m. EST, and just appreciate the people that have joined in over the several hours. We've covered all different types of topics from live trading. We've had crypto and NFT talks. We've talked FOMC. And a bunch more earnings. And then still coming up, we have this space, then we have another space after this with the team over at Beehive, where we're actually going to be breaking down sports media and the NBA playoffs. So stick around for that if you are a sports fan. So much to come. And then I'll also just note again, if you want to be seeing more spaces like this, these speakers up here are great to be following. Not going to kind of run through everybody, but there's a lot of knowledge on the panel. There's some great people writing threads, all different types of content, analysis, insights. And then again, I'm doing about 40 to 50 hours a week on Spaces, and appreciate everybody who's tuning in. If you want to make sure you're not missing any of the Wolf Spaces, there's a brand new feature that they added to Twitter recently. If you're following me or not following me, you can just click in my profile and see it. It is right next to the following button. There is a bell, and you can turn it on just for Spaces. So I don't want to annoy anybody with too many tweets. I like to tweet, but I will say it is definitely worth your while to have that bell on for Spaces. So you're not missing some spaces with super valuable guests such as these that are on here right now. All right, Bill, appreciate the patience there. What's your question?
Not a question, but I wanted to point out a couple of other macro trends. Obviously the Fed was front and center today, and deservedly so. But I think there's a couple of other trends that I think are going to play an important role in sort of how the U.S. economy progresses that I don't think people are paying enough attention to. One is on the fiscal side, and obviously the Fed is very important and has an important role to play. But I think what people aren't focusing on is how rapidly, the federal deficit, which was rightfully large during the pandemic, is shrinking rapidly, and that it's related to one of the things that the Fed is worried about, which is rising wages, and you can see it in the way tax revenues are flowing into the Treasury. I mean, they report every day a cash flow statement, and if you track it, you can see that federal receipts from wages, right? So this is payroll deductions, which is 80% of what makes up tax revenues into the U.S. Treasury. It's booming, and I think this is part of what the Fed is worried about, right? They keep referring to kind of rising average wages, and it's playing out in real time in the way the U.S. Treasury is collecting tax receipts. And the point is, we've run a surplus in so far. It's early in May, but May's a surplus. April was a huge surplus. January is surplus. Like the deficit is almost zero right now through 5 months. Now it won't stay zero, but that is really important because, for example, in April we had such a huge surplus that it actually acted like QT, right? It did the U.S. Treasury, by taking in so much tax revenue versus its expenditures, actually removed almost 12.3% of all bank reserves in the banking system. I mean, that's basically, if you think long run, the Fed wants to do 95 billion a month. That's like 6 months of QT all in 1 week during April after tax season, and that seems to be continuing. And I think that could put some pressure, some sort of deflationary pressure on the U.S. economy. So that's kind of trend number one. Trend number two, which was reported today but didn't get, I think, nearly enough attention, is the trade deficit exploded. I mean, much higher today than anybody expected. It was like, came in like 110 billion for March. And I think that's also important to watch because I think it's going to get even bigger in April because of, the fact that the U.S. Treasury is not kind of giving us enough of a deficit. I think that's also important. That's basically, if you think about it, when we run a trade deficit, we're exporting U.S. dollars to the rest of the world, and the U.S. dollar is strong because I think there's actually a shortage of U.S. dollars right now temporarily because of that big surplus in April. So, the bottom line is, for the deficit, if the U.S. Treasury runs, let's say, a surplus, I'm not saying they're going to run a surplus, but it could happen because if spending is coming down because all the one-off programs from the pandemic are not repeating, and tax revenues continue to boom. The flip side is the private sector has to run a deficit if the U.S. government runs a surplus. What that means is they have to, reduce their savings or go into debt to maintain consumption. But in doing that, they're also competing with the foreign sector through the trade deficit, right? People think, well, trade deficit's because the U.S. consumes too much. And I actually think the causation is backwards. I think the rest of the world needs dollars, and the only way they can get them is by net exporting to us. So if the current, March trade deficit continues, that's equal to about 5% of GDP. That's how much the foreign sector is trying to remove US dollars out of the domestic economy. And if the deficit is also shrinking, I think that's going to put pressure on the US household sector, because they won't be able to maintain their consumption without driving down their savings or increasing debt. So I think one of the things you're going to start seeing is reports about the falling savings rate in the US. I think you're going to start seeing those headlines. And to me, this is a setup that's starting to look like 2000, 2002. In 2000, the US ran a surplus for several years. And then in 2001, China got admitted into the WTO, which exploded the trade deficit. And the result of that was just a massive amount of debt increases for the household sector. So it's something to watch. I'm not saying it's going to continue, but I think these are sort of trends that are all sort of starting to, it's kind of early days, but I think it's something to watch going into the future.
Awesome, Bill. Appreciate the in-depth analysis there. Thank you for coming up and for the polite DM to speak. Some people don't get it. All right, I see some more hands. Xavier.
Wonderful, thanks. So, I think we can conflate a lot of issues in this discussion, like about the role of international capital flows or supply issues. But at the end of the day, the problem is nominal, and that's what the Fed needs to be focusing on. Just nominal spending. Supply issues, maybe they genuinely do politically care about. I won't lie and say that the Fed is an actually politically independent institution. It does try to be. But they should stick to their targets and the issues that they say they care about. Core PCE, not look at excessively volatile, especially right now, food and energy prices, and instead should focus on nominal income and nominal spending, which right now is significantly above trend. Mercatus just put out the NGDP gap today, another update on it showing that it was still 3 to 4% or so. And this is why part of the sector by sector analysis, like looking at goods versus services, has been really annoying, at least for the last 6 months or so, that it's been a major focus of a lot of portions of the finance and economics world as we deal with the inflationary issues. At the end of the day, the Fed only has tools that control those nominal variables, and so they should use them in that regard. I think David Beckworth, one of the more legendary market monetarist economists, tweeted something about how, well, if it's true that they can only control nominal variables, like Powell said, they should adopt a framework like nominal income targeting that actually uses them. So they should tighten as long as the nominal income gap is high and positive. And all of these other details actually can fall to the wayside, I think quite a bit. And the Fed should focus on what's important.
Got it. Appreciate that, Xavier. William?
I want to plus one everything Xavier said. The clearest and most consistent way for the Fed to maintain things is to ignore the noise and focus on nominal targets, which allows them to best balance between their mandates for employment and their mandates for inflation. I think regarding to the two speakers ago point about surpluses, the U.S. Treasury is not going to be running a surplus for 2022. Not only have they not run it for the first 3 months, those are often they are certainly scaling back the extent of their deficits because things like the stimulus is over. But they were going to be running a substantial deficit and hundreds and hundreds of billions of dollars that I do not think they're not actually going to have a surplus. But I agree. I actually used to work at the Fed. I was at Federal Reserve Bank of New York up through 2021 before jumping over to Kalshi. And the importance of a clear and consistent guideline cannot be understated. When Powell says we do not have an ability to handle supply shocks well, and we are facing an environment with frequent supply shocks, whether that's COVID or the resurgence in China, this is just a reason for why the Fed should not be trying to do so. They have, as Powell said, a blunt instrument. And that is why clear and consistent guidelines, which is nominal targets, which they control almost completely. They control nominal variables. They do not control real variables in the medium term, is the clearest way to do so. And that's actually why we should be looking at market indicators for whether things are going to be successful. The 5-year break-even rate has fallen substantially over the last week, and that has reversed the surge that we saw in March and April. And now it's about 3.5%. And after you strip out this year, that means about 2.5% for years 2 through 5, which means that the Fed is broadly getting near what their stated target is, and that is using market-based indicators, which is probably a more comprehensive way to anticipate the future than going sector by sector and saying, well, I think X sector is going to go up, X sector is going to go down. The sum of the market's wisdom is probably more likely to be accurate than not.
Got it. Awesome. Okay, I saw two hands. Wolfie, I saw your hand up, then I saw it down. Did you have a comment?
No, it was an accident.
Okay, all good. Coming over to you, Jay.
Hey, so I think there's two frames of thought on this space. I think there's one frame of thought that just believes the market's fully efficient, whereas I think it's fairly reactionary. If it was efficient, we would be at one price the entire year, and everything would be priced in whenever it's brought up. I think in reality, I mean, when you look at what happened with Volcker and the oil shock of 78 and 79, when he raised rates from 11.2% in 1979 to 20% in June of 1981, that started, because of the oil shock, right? And then it continued until the unemployment rate became higher than 10% during his time there. So I don't think, while it's nice to think that the Fed, should act, and target, maybe use the Taylor rule or some, hypothetical framework. In reality, they haven't really stuck to a framework in decades, right? If you think about, what they did during COVID, it was necessary, but the fact that they're so dovish, 10 years after the great financial crisis, kind of shows you that, they took inflation for granted, and it's one of the reasons why, they're so concerned today, because I don't even think half of the Federal Reserve governors were adults during the last period of inflation. And I know Powell talked about wages, and he was concerned about consumer budgets, but the Fed is more political than it's ever been. In fact, I think the Fed would have made a bigger mistake by waiting to hike even later if at 4 of the last press conferences, Republican congressmen hadn't, belittled every Fed governor in front of, hundreds of thousands of people watching on Bloomberg and CNBC, right? Like, if, whether it was the prior administration or this administration, there is political pressure put on the Fed. And, when it's after Powell got reelected that he became more hawkish, because he knew he was going to be around for a while. So I think that it's nice to believe that everything is efficient, but I do think the market has been insanely reactionary. If you look at the dispersion across sectors and the rotation across sectors and the compression in PEs, I think we're in for a lot of chop, and I think we could have some pretty wild swings in reaction to this meeting, in reaction to the upcoming CPI, in reaction to declining margins, in reaction to the weaker consumer. And there's only really one way for earnings to go from here. It's funny when you read sell side analysis, and they'll say, well, the first quarter was weak, the second quarter was weak. Our expectation for the year was 10% growth. But the first 2 quarters, you were only up, you were up 1%, then down 1%. So the second half of the year should be up 20%. That's the type of analysis that Wall Street uses. And it's frankly pretty asinine. But I think a lot of companies, still have to bring down guidance. Imagine if Netflix had said, instead of whiffing on the first quarter and saying, hey, we lost 200,000 subs, but it would have been 500,000 subs, if it weren't for Russia, Belarus. And the next quarter, this current quarter, is going to be negative 2 million subs. What if Netflix had said, in reality, we're probably going to lose 5 million subs this year, because we're seeing streaming, cancellations across every channel. We're seeing it in Europe. We're seeing it in the US. The stock would have been a lot lower. And management teams tend to withhold, that type of guidance when there's chop. They wait for things to get better. So if the consumer situation doesn't get better and inflation doesn't get better, you're going to see companies talk more openly about margin compression, because there are very few companies that kitchen sink this quarter. One of them was Teladoc. But most companies tried to, point out positives as we go into the year. And I'm just worried that coming from the highest margins we've seen in recorded history, that there's only really one way to go from an earnings perspective.
Got it. Yeah, certainly a tumultuous time in the markets, but some great insights there from Jay. If anyone's not already following Jay, he puts out a ton of great analysis and insights. Jay, I'm sure you have some good write-ups and other information that's coming out following this.
Absolutely. I have a few write-ups coming on macro fundamentals. I have a SPAC Catalyst write-up coming up. I have a spin-off, split-off. There's a huge MBO announced in Europe, which could become a hostile bidding war regarding a video game company that we have put out. And we have put out some really unique pieces on uranium companies, as well as a couple of things coming out on an activist REIT situation and a pipeline situation. So a lot of fun stuff happening at this point.
That's awesome. Definitely looking forward to getting into more of those opportunities. Okay, so we have about 12, 13 minutes left here before we are going to keep the space open and roll into the next space. One more time, shout out to the great speakers that are on here. Wolfie and Special, I asked you guys kind of last minute a couple hours ago to pop in, and you've added a ton of value to the space. William and Xavier, great being on another space with you. Sahil, College team, appreciate you, of course, making the time for us. Second one this week, so good to see that, and excited to keep the ball rolling here. So I feel like we've kind of gone over a bunch of different topics. Wolfie, I want to throw kind of a question to you that was asked earlier on the street space, which was coming out of the FOMC. It's hard to say how this affects things long term. We got a little bit of a glimpse. Are there certain sectors which you are leaning more bullish on long term, following up on the news from today?
Long term? Could we define long term?
Yeah, 10 to 20 years.
Well, I don't think that's funny. I don't
Hey,
think
man,
that
it's entertainment, right?
if you've got like a 10, 20-year outlook, I don't think that.
Can anyone hear Wolfie?
No, he cut out for me, but I was thinking sometimes my Bluetooth connects to different things. I think he was about to roast me for asking how a one-day move in.
I don't want to speak for Wolfie, but he might have been saying if you have a 10 to 20 year time horizon, it doesn't matter. Like none of this really matters.
He was going to insinuate that. I was setting him up for a little bit of a slam there. Not gonna lie, just because the street asked me that question on a space earlier. I was like, okay, interesting. All right, while we're waiting for Wolfie to get back, though, and hopefully he'll be back any minute, I brought up options at work. Did you want to throw in some insight here?
Hey, guys, can you hear me okay?
Yep.
I'm really sorry if you guys just already covered this. I just hopped in. Have you guys talked about what maybe your predictions are for the next 5 to 10 days as far as just the general market movement goes?
Yeah, we have talked a little bit on that. I think it was William who responded. William, is that the one that you talked about beforehand?
Indeed, yes.
I'm basically curious, if I'm kind of wondering if we won't rally fairly well, maybe up until CPI comes out, and then, once again, keep going back down to where we were, or, wouldn't mind your intake there.
Yeah, just a, Cliff Notes version is, I think that the information that is gleaned from the FOMC announcement at 2 and Powell's comments at 2:30 are largely already been incorporated into prices. I do think there might be movement later as people read into more and think about it, but not in like a decisive direction where it's like, we know it's going to go up. As for the CPI print, well, maybe, if the CPI comes in less than expected or more than expected, on expectation, we should not expect the market to fall after the CPI print, because if we expected the market to fall after the CPI print, then smart traders before the CPI print would just sell, and then the market would move before the CPI print. That's not to say the market will not move on that announcement. It certainly will, but on expectation, it will be where it is now. We just are uncertain about the way that direction goes.
I like that answer.
Cool. Any other thoughts or questions?
Hope everybody makes some money.
There you go. All right, Josh, I'm giving him just a second to get up here. Josh, can you hear me?
Yes, I can.
Josh, first off, appreciate you being a loyal listener. You've been tuning into all these, man.
Yeah, as often as I can. Sometimes I have, like meetings and stuff. I got to drop off for hours, but try to catch them. It's very good information. I always appreciate it.
Absolutely. So you shot me over a good question in the DMs. You want to ask that on here, and we can kind of drive it towards probably Wolfie or Jay?
Sure. First off, I want to say, as soon as you promoted me, I missed like 10 seconds. So I think that's when the delay gets. We were talking about that delay earlier, so I just wanted to give you that feedback. I missed about 10 seconds of whatever you guys were talking about right before when I got promoted.
Yeah, that happened to me too.
Got it. So the question I had is that the secondary market is obviously locking up. They're looking for very high interest rate loans from the banks. The Fed is no longer buying mortgage-backed securities. How do you see the banks kind of handling the liquidity issue that they're going to run into for 2023? And also wanted to ask a second question, which is the 3 to 5 year ARMs that are being created at this moment, I think is also going to create a problem for the banking industry in the next 3 to 5 years. And what do you think about that?
You want to split that up into a couple different questions. So adjustable rate mortgages today are a very small percentage of the overall mortgages that are outstanding. I think it's a different environment than what we saw in 2005, 6, and 7. According to Ellie Mae, the market share for adjustable rate mortgages is only 4% of all mortgages in the United States today, which is, markedly lower than it was at that time. So, on the margin, do you take some incremental risk? Yeah, potentially. But one could argue that, the long end of the curve, may not have a lot more to go. And, if the economy does slow over the next couple of years, we might be in an environment where rates might be a little bit lower. I don't know if, this presents like a systemic risk at this point. On the consumer lending side, there are companies like Lending Club, Upstart that have been providing very high cost loans to consumers with low FICO scores. And, in the 580 to 620 band, you see CPRs as high as 36% because of they can get around. There's certain states have caps on usury, but if you lend out of Utah, you have a higher you have almost an unlimited rate where you could lend at 40%, whereas in Jersey it's capped at 30. So I personally have seen consumer borrowing rates go up in securitizations. I have seen consumer risk and credit card borrowings go up and started in December of this past year. And I do think that consumer borrowing will go up and that will present a risk at some point later in the year. But I don't think, I think people start noticing it at the very bottom tiers in the highest credit risk. And it will cause some hedge funds and insurance companies or in the space to take losses and perhaps stop buying that paper, which would make credit less available to low-income borrowers. But on the ARM side, I don't think it's a systemic risk. And then just quickly on the CPI, et cetera, what matters is what the print is versus expectations, right? So CPI is coming out on May 11th. It's projected to be 8.5%. The last print we saw was 8.5%, and the ex-food and energy was 6.5%. So what you have to do is, when consensus expectations are out, you need to compare that to what the print is, and no one knows what expectations are just being put together right now. So the market may have a short-term reaction on that day, depending on whether we're far above the consensus or far below the consensus, and there's no way to really predict that at the present moment.
Perfect. Any follow-up on that, Josh?
No, no follow up. I was just curious about liquidity issues that may come into play for 2023. I know community banks have a good cushion for 2022, but I can see, like, I already see a lot of community banks raising CD rates and scrambling for deposits, where especially because the mortgages aren't being bought in the secondary market. Um, do you see any like short-term exposure when it comes to the community banks or other type of institutions in that market?
So the banking sector, the tier one capital ratios and liquidity in the banking sector has been the highest we've seen, frankly, in decades. And they should raise CD rates, right? You should earn something on your money, but the rates at which they're lending, right? Banks make money lending on the yield curve. They borrow short and they lend long. And as long as the yield curve is upward sloping, they make substantial profit, which is usually levered 10 times. And they make a 12, 13% ROE, based on that on average. Tier one capital ratio, right, at 12% for the money center banks and around there for regionals provides a really big cushion for charge-offs, and the amount of liquidity that these banks have, I think, is actually pretty decent. You would need a severe recession to really cause any type of contagion in the banking sector. From a liquidity perspective, yeah, I mean, there might be some issues, right, as we start QT, but I think Williams probably, given that he's in New York Fed, he's probably well positioned to talk about how QT is going to, what ripple effects are going to be in the banking system. I frankly don't see an actual risk of liquidity issues or insolvency at any of the major banks.
And I would agree with that. I just see some opportunity or some potential revenue loss or profit loss because they're not able to sell the mortgages and make some upfront income. They're going to have to hold the paper longer until weather the storm the next 3 to 5 years until the market starts opening up again. And I think that's going to raise rates even more.
So the conduit engine, if you look at, there are a lot of mortgage REITs that actually have public financials and they're pure plays, right? So you look at a company like Mr. Cooper, or you look at NRZ. You have companies that have 600 billion plus UPB exposure to mortgages, and they're large mortgage servicers and originators. And you can see from their latest earnings, they both reported over the last week that mortgage originations have fallen dramatically. And that was, the first quarter ended on March 31st. That was when, the 10-year was 2.34, and mortgage rates were much lower. Mortgage rates are up like 1.5%. They're up at 5.6% now. So expect originations to be even lower. And, the originate to sell business, right? Originating, selling at, to securitization at a premium, that entire business is gone. Like last year and right after COVID, you were getting 4 points, free money if you were participating even with Fannie and Freddie. And if you're doing non-QM mortgage originations, you were making 8 points. Levered, these guys were printing money like I've never seen in my life. But that's completely turned around. And I agree with you that mortgage originators are going to have a tough time. But I do think that they have enough capital and other lines, and banks themselves have other capital have enough capital in other lines of business to keep going. So if you're talking about earnings, will earnings be lower for mortgage originators? 100%, unless they own the MSR. And MSR is a mortgage servicing right. And mortgage servicing right increases in value when you have less mortgage prepaid. So when refinancing, and I'm sorry if it's getting complicated, but when refinancing slows down, it lowers the amortization of the mortgage servicing rate. So when you originate a mortgage, you have a servicer. So let's say you originate a mortgage with Citigroup, they have a servicing stream of income, sometimes 50 bips, 75 bips a year, which is a lot of money, for example, on a 400K loan. And that servicing revenue goes away when you refi with someone else, or you pay off your mortgage. If mortgage prepays come down, that the net present value of that servicing fee goes up dramatically, and it offsets origination. So if a bank for example, originates its own loans and maintains the servicing, usually the servicing, the net present value markup on the MSR offsets the lower origination volume revenue. But if you sold your servicing rights and you're just originating and selling as a conduit to a bank and you're a really small firm, you are in a really tough spot.
Well put, Jay. Okay, so this was awesome. I want to go out there and give a huge thank you again to Jay and Wolfie for taking this on 2 hours' notice, to Sal for coming in and being a part of this, William, Xavier, Kashi. I know Tariq was here as well. We had an amazing hour. Again, if you want to learn more about it, just make sure that you're following the speakers that are up here. They're going to be putting out tons of information, doing spaces like this all week. I do have another space that is starting right now. So, Wolfie, I'll go to you for final comments, and then we'll get rolling with this next one.
Hey, I just wanted to give a shout out to you. Congrats on getting verified. Just a little heads up to everybody who hasn't congratulated you, to give you a shout out. And that's it. Thanks for having me on.
Appreciate it, brother. It's been a long work in progress for many a month, and I was very excited to see that happen live on Spaces today. I also found out that you can't put the word verified in your name on Twitter. I didn't know that beforehand, but I was going to make my name Verified Wolf for the day, and you can't actually put it in there. There's a Twitter thing stopping you. So that was pretty cool to see, but I appreciate that. Shout out, Wolfie. Have a good one, bro. All right, so I want to let everyone know, if you've been in Wolf Spaces,